Hey there. Welcome back to Great Quarter Guys, the show where the lines between freight and finance are none. This is episode 57. I'm your host, Andrew Cox. I've got Seth home with me here as well. It's been a busy week in the freight markets. Not only have the freight markets reversed a little bit of a downtrend in January, have picked up a little bit of steam here in the third week of January, but we had some big news on a huge acquisition of UPS Freight. So we're going to break down the pros and cons of that acquisition, what we see the potential for TFI International and that acquisition, where they can go from here. We may also talk a little bit about Bascome Majors, the analyst at Susquehanna. He downgraded 6 trucking stocks. We may get into that if we have some time. But before that, we're going to do You Care or Nah. So Seth, I'm going to give you an idea, a topic, or event. You tell me whether you care or not and why. All right, so first one is a little bit of economic data. We had some recent housing data come in. U.S. existing home sales reached the highest level in 14 years in December. Seth, you care or not?
Yep, I care. This is great news for trucking. Continue to see the benefit of lower interest rates. COVID is definitely playing a factor here, as well as people, leaving the cities and moving to the suburbs. Two things that I think are sort of interesting out of that is whether once people are vaccinated, I kind of think that a lot of, at least the younger people, will head back to the city. But I guess that remains to be seen. And the other thing is, the price increases you and I were talking about are definitely going to soon start to offset some of the benefit of these really low interest rates. So the average 30-year fix right now is about 2.77%, but the average national home price is also up 13% because there's no supply. So yeah, I do care.
I'm with you on this one. I care very much about this as well. You're right. The biggest issue for the home builders and for potential home buyers is the supply. So homes for sale in December were down 23% year over year. We have just less than 2 months of supply. That's a really low supply of houses. I wrote on Friday in the DHL supply chain pricing power index that we needed another source of freight. You mentioned this last week on Great Quarter Guys when we talked about industrial production, and it was great to see some additional sources of demand and a broadening of the economy away from just stimulus-driven, consumer-driven demand. The one thing I do see here that's a little bit frightening, it's positive on one side, but frightening on the other, is that this is kind of this could be evidence of a potential long-term effect of COVID. And that's just the dichotomy between the people that did lose their jobs, the lower income, lower skilled workers, and the ones that didn't. You just have job losses. Most of them, the majority of the job losses came from that lower skilled and lower income earners, but the higher paying jobs weren't hit as bad. And then they still had they took no vacations, didn't spend money on services. So they have a better war chest to go out with, which is a great thing. But I mean, it could be evidence of this dichotomy as well. One thing I wanted to speak about was just the possibility of a potential pull forward a little bit, maybe, and this is something that you and I laughed about off air, but I wonder if potential home buyers have any idea of the Federal Reserve or any idea that there's a potential that they've put out some inklings that interest rates could be rising towards the back half of the year or next year. I wonder if that will have any effect on demand. Maybe people get excited and buy before, but you had a funny thing to say about the Fed.
Yeah, backed by no evidence. But my guess was that a lot of Americans either don't know who the Federal Reserve is, and if they do, they don't follow them. I think home buyers are, in terms of FOMO, fear of missing out, I think they're much more likely to respond to either 30-year fixed. I think they're more likely to watch 30-year fixed rates and where those are tracking. So if they move up too far or too fast, I think that FOMO sets in. But to your point about, I think, one, in addition to stock prices, I think you made an interesting point there. This is just another unintended consequence of, easy money from Fed policy, which is that it disproportionately benefits higher income people who can afford houses and buy stocks and all that kind of stuff. So it sort of magnifies that inequality there as well.
Right, precisely. Last thing to note is that the South posted the strongest gains this year with sales up 7% year over year. Had to put that in there. All right, so the next one here is on.
Surprising.
No, not at all. Chattanooga and Charlotte, North Carolina, some big winners in that southern region. So the next one is on foreign direct investment. So China overtook America as the world's top destination for foreign direct investment this year. Seth, you care or not?
I don't care on this one. I think this is much ado about nothing. It makes for a great headline, and it looks like the U.S. is, in major secular decline, and China's, just riding that star to the top spot. But and I believe Xi Jinping was, addressed the World Economic Forum as the keynote, and this made a lot of headlines. But really, I mean, Europe was, if you read the Wall Street Journal article, Europe was down 75% too. I think a lot of it is a function of not only how they better handled COVID, but the fact that they're coming out of it earlier. In other words, I expect foreign direct investment in the U.S. to pick up in 2021 and 2022 again. As you can see on this chart, China's been steadily rising. And I also think that, the Trump administration and their mercantilist policies probably hurt this a little bit, as you can see on those blue lines over the past 3 or 4 years since he got in office. And so you'll have a net benefit from, sort of more agreeable foreign policy from the Biden administration, as well as economic rebound. Both of those things will help that number in the U.S. and I think they'll overtake China again.
Yeah, I have a lot of the same notes. I saw the U.S. was down 49% this year. Again, I don't think that has anything to do truly with, not to say so much to the secular decline, more so much as just the effect of the virus. But total foreign direct investment remains substantially higher in the U.S. in total than in China. I was just seeing something that Samsung is scouting out new locations for a chip factory that they're going to build either in Texas or Arizona, somewhere in the Southwest. It's a $17 billion investment. So that would have been like 15% of this year's total investment just on one plant from one company. And that's going to happen in the next year. So yeah, I don't think this is anything to worry about. I don't care about this number. I didn't come out and say that, but I'm with you on almost everything you said. All right, so next one.
By the way, just one, that's an annual number. That's not a total number, like you said, right? So,
yes,
I mean,
correct.
this is the first annual year, but if you look at the U.S. in terms of a cumulative total number, it's way bigger, and I think it'll remain that way.
Yes, agreed. Probably somewhere down the road, China does take over, but I'm hoping it's many years away. All right, so third one for you is on a partnership between Aurora Innovation, the company that just bought Uber's ATG autonomous vehicle division. They have linked up with PACCAR to bring autonomous big rigs to the market in the next several years. Seth, what you think? You care or not about this partnership between PACCAR and Aurora Innovation?
I do. I care. I think PACCAR's it owns Kenworth and Peterbilt, right? And so I think their market share, last time I looked at the OEM market share in the U.S. and North America, it's like a third between Volvo and PACCAR, and I'm blanking on the third right now, but I know it.
Daimler.
So I think I think you have to care. The other thing is, it does feel a little bit. One thing that I've noticed is I've gotten a little bit more bullish on autonomous trucking, both because I have a friend who works at a big trucking company who has sort of made me that way, who knows a lot about this. And on the midday market update last Thursday, which you're on, I think it was the CEO or the CTO of Kodiak Robotics was on there. And I thought he laid out like a really sort of well-spoken, compelling case for why the future of, ATs rather than AVs are a lot closer than most people think. And that, it was going to surprise people.
Yes, I do care about this one as well. I love that Aurora. I really like Aurora Innovation, by the way. After doing some research on the team, they're led by 3 former leaders at Waymo, Google's autonomous vehicle division, from Uber, and then from Tesla as well. So they've got a lot of experience in the autonomous vehicle sector on this team, and they're not wasting any time. I mean, they just closed that Uber deal on a Tuesday of last week, and then the next day they announced this deal with PACCAR. So I think that they're moving quickly. They've been testing commercial vehicles testing their tech in PACCAR for about a year now, apparently, and have done some commercial runs in the Fort Worth area. But I think this is their first partnership in the big rig space, in the actual with a Class 8 OEM. They've got some deals with Hyundai and our new favorite Stellantis as well on the commercial vehicle side, or on the personal vehicle side rather. But I think this is their first one on the big rig side. So yes, I'm very excited about this. It follows some similar deals we've seen from Daimler and Waymo, and from the VW group Triton, and Too Simple. So I think this is great for Aurora. I'm excited to see them enter the big rig space and see where they go with it over the next few months. All right, so last one for you. This is on Costco, one of your favorites. It is testing out curbside pickup at a handful of stores in New Mexico. What you think? You care or not?
I care. I love Costco. You know it. I was at Costco on Saturday. One thing I like about Costco is I think the CEO said our head isn't buried in the sand, but they play a different game even than Walmart and Target, who've been really successful with curbside pickup. Have a lot of other retailers. Costco was a little bit late to launch in a major way. They're online, but over the last few quarters, that's really been picking up and becoming material for them. So Costco also has the treasure hunt in their store, and the stores are always packed. There's not enough of them. Do you know how many global Costcos there are, Andrew?
1,600.
500 last time
No
off
way.
the top of my head. Yeah, which compares to Walmart. It may be more like 550, but Walmart, I believe, has 5,000 in the U.S. So they like that sort of scarcity factor, that treasure hunt experience. And so I think it makes a little bit of sense why they've been delayed. I mean, I would love it. I personally enjoy going in the Costco and going through all the aisles, and that's why they move all your favorite stuff around on you all the time, other than the wine and the food. Everything else moves around, so you have to go find it. I don't think it's going to be some huge needle mover though for Costco, because I think the vast majority of their customers will continue to kind of go in there and buy it and pick it out themselves.
Yeah, they've said that this isn't going to be a nationwide strategy anytime soon. They're testing this very limited in a limited basis, just in three stores in one market, as I said. But yeah, you're right. Their stores are magnets for product discovery and finding new stuff. So they've been reluctant because they haven't needed to. Their CEO has said just as late as I think November, he basically said that other people are adding curbside because they have to or they feel the need to. But as you said, I think the next line came, we don't have our head buried in the sand. And I do care about this because it could be a change in strategy for Costco. I don't think they need the change in strategy, as you said. I think that especially once COVID is over for them, they've gained a lot of market share as other grocers have not been able to survive 2020. And then, a lot of their pitch to customers, the sampling, the experiences you can have inside the store aren't available to them right now. So it's an even better story leaving the pandemic than it was coming in, I think.
Yeah, agreed. And, I used to always worry about Costco, which is, how can this retailer trade at 40 times earnings and not have any online revenue? Like eventually that's going to end badly, but they always seem to find a way. And even in this age of COVID, where e-commerce has gone from, 11% of retail to 30 or 40, they've done better than ever. So.
One thing I wanted to note that I touched on when I talked about this on the midday market update was just this idea of e-commerce in the U.S. and how we're so search based. Like our whole idea of e-commerce is based around the Google search bar and the Amazon search bar. We know what we want typically when we go, which is the complete opposite to the way that Costco tries to add value and tries to increase revenues, which is that browsing product discovery. So I think that they're going to have to be creative in the ways that they can grow e-commerce with still having some sort of experience of treasure hunting, like where it's huge in China. They have a much bigger browsing e-commerce space where people go online not having any idea what they want to buy, just with money to spend. But that's not the case in the US. So I think that Costco could be one of the ways that if they get creative on how they do this, they could be one of the leaders here. Amazon does similar things, just with, there are things that say, people that bought this also bought this, or people, things that pair well with your thing that you did buy. So I think they can get creative there. But all right, let's shift gears. Let's push on to our main topic of the day. That is the UPS Freight, the acquisition of UPS Freight by TFI International. So UPS is selling its LTL division to is selling its LTL division, UPS Freight, for $800 million. This reflects the UPS plan to focus more on its core parcel business, which is surging with growth in e-commerce. The market also really likes it from both sides. TFI spiked 22% on the day of the announcement. Tom Wadowitz, an analyst at UBS, believes the impressive move up in the TFI stock is a clear reflection of investor confidence in TFI's management ability to deliver margin improvement in the business. Seth, you said on our Slack channel that if TFI can turn this around as fast as the market assumes, I'll be impressed. We'll circle back around to that comment. But why don't you detail a little bit about why Tomei, the new CEO for UPS, was so quick to divest this division of UPS Freight. She just became CEO a few months ago.
Yeah, I mean, so many thoughts here, and I would start out just by saying, like, TFI International is actually, I've learned a lot in the last 24 hours. It's one of the companies that I'm not closest to, so I don't have totally fully formed thoughts here. But we are going to do, I write our passport research along with a couple other analysts at FreightWaves, and we're going to do a deep dive on this on Thursday. So if you are a passport subscriber, look out for that, and I'll have sort of more well-formed and more well-researched thoughts around a lot of all this. But to your question on UPS, so I think Carol Tomei's overriding philosophy since she got the job, she's been on the board for 18 years, like you said, since 2003 at UPS. She was also the longtime CFO of Home Depot, and she's known for efficiency. So her overriding philosophy was to not just grow, to grow, right? To grow profitably and to grow as sort of EPS and return on capital as fast as possible. So this makes sense. It's a non-core asset. Even though it sounds huge, 800 million in revenue is very small for UPS, given their size. This thing has the UPS Freight has not been. It had basically, somewhere between a 0 and a 2% operating margin, or a 98 to 100 OR in the last year, and it's been shrinking slowly, and it's been a problem for UPS as well. So I think this is a way to quickly shed an underperforming asset, build up cash, and also boost. The UPS said in their press release that this would boost their operating margin and return on invested capital by 20 basis points. And so then it also sends just a greater signal to the market that Carol means business, and she's pruning the portfolio to focus on core parcel assets that are faster growing and higher margin.
Yeah, you're right about that. I want to take a minute just to go through a couple of these notes here. So Satish Indel, the president of ShipMatrix, he believed that UPS never really seemed to be serious about their LTL division. He said that huge tech investments that UPS has made in the top of its company have not really trickled down to its LTL business, which he thinks is in desperate need of digitization. He says, we also, in the FreightWaves article, you can go and read on FreightWaves.com, they talk about the integration of Overnight into UPS. The Overnight Transportation was the company that was eventually rebranded to UPS Freight. They said that the integration was fraught from the start. The ink was barely dry on the transaction when UPS executives descended upon the headquarters in Richmond and began to make major changes. But the problem was that apparently UPS was trying to apply its parcel-centric learnings to LTL operations, and they quickly learned how much different LTL is than parcel. The integration moved very slowly. The cultural fit never seemed to feel right. UPS did maintain the headquarters in Richmond, but the unit operated on a different wavelength than the rest of the UPS organization. But integration wasn't even the biggest operational misstep for UPS Freight. So Seth, you're going to give us more details. The Passport members will get more detail on Thursday, but they had a big problem with the way that they were selling these freight services, bundling small package and LTL services together. So that kind of leads into the cons and the pros of this story. So let's go through the cons from TFI's perspective. So Seth, you want to start off with just there at the top?
Start off with the cons, you said?
Yeah, we'll go into some of the cons. So the first one there was that they have a lot of these unprofitable contracts because of the pricing strategy that UPS Freight was implementing.
Yeah, I mean, so I'm trying to think in my head how to. So it's a very hairy asset to begin with, and I don't know that I would call it broken, but it's 4 different parties have owned this for the better part of 35 or 40 years. And starting at least as far back as I could tell, Union Pacific bought this back in the mid 80s and lost a bunch of money, and then had to spin it off, and then it got bought by UPS, and they weren't able to turn it around amongst other people. So I think it's also unionized. That's one point that bears are sort of latching onto, which adds a lot of costs and reduces the margins. You spoke to the pricing strategy, which is certainly not optimal, and it was being run as sort of a smaller division of a gigantic parcel company. So now they are gonna continue that relationship for 5 years with existing customers. But I do think that TFI is going to have to re-implement the whole sales team and the whole sales approach. And they're actually supposedly, I haven't had a chance to listen to they had an M&A deal call for investors yesterday, but they spoke to the likelihood of basically purposely shedding, call it $1 billion of this $4 billion in revenue, because it was revenue that was unprofitable with over 100 OR. So lots and lots of work to do here, and other people haven't been able to turn around. I would say the caveat to that is they didn't pay much for it. They paid about 0.25 times revenue. You can't really compute any below the line items valuation multiple because it loses money. But that being said, compared to the LTL comparisons, even the ODFL trades at above 5 times revenue, and you've got it somewhere in those notes. I believe Saia is at 2 or 3, and the other unionized LTL players are at least double that, around 0.4, 0.5 times. So one could argue there's a margin of safety because this came with a ton of trucks and a ton of hubs as well. But my overall sense is, and I think everyone would agree, is this is not going to be easy to turn. It's almost like turning around. It's a multi-year turnaround, and it's like turning around the Titanic and or a big ship, basically. Maybe not the Titanic. That's not the greatest metaphor, but turning around a big slow moving ship, I guess, is what I'm trying to say.
Right. So the 3 cons that we can touch on here are the problem with some of the contracts. So Alan Bedard, the CEO of TFI, said that he was actually surprised when doing their DT about how many of the contracts actually that the UPS Freight had that were running at over 100 OR, just losing money on these contracts. So that's going to be one thing. They're going to have to reshape the sales force and how they're going to be pricing and selling this freight. The second con, of course, is that, yes, it is a unionized shop. Unionized shops in general, as you just mentioned, get a much lower multiple on valuation. And then the third here is that they've said that the trucks are the number one priority on this integration. So they're going to be buying a lot of new trucks, trying to bring that age fleet down, which inherently tells you that they paid more than that maybe price that was paid, the $800 million, right? Explain that a bit, just knowing that they're going to have to put some money in on CapEx. I think they said they're going to have to double their annual CapEx here in the first 2 years.
Yeah, I mean, it's just, if you buy an asset that's been underinvested in and you have to invest in it, that just effectively increases the purchase price. If your average fleet age is 3 or 4 years and you want to bring it down to a year and a half or 2 years, which is what a lot of the enterprise truckload carriers are at, just to lower that maintenance expense, lower that downtime, improve the asset turns. That's likely. You can kind of go through the math, but if it's all new trucks, it's 150 grand times, right now I believe they have around 6,500 total LTL trucks. So, I mean, you can kind of do the math based on whatever percentage they need to upgrade.
Right. So let's take a look at some of the pros here. So the first is obviously just the assets that they were able to accumulate here with this transaction. I think we've got a chart here of just the number of hubs and terminals that UPS or that TFI is adding here. So the TFI is in yellow, their previous terminals, which are pretty much all spread out across Canada. They've also got some operations in Mexico. We're going to talk about that being a big point here as well. But look at all those blue terminals and assets they get. I mean, they're paying more or less book value, or maybe a little bit less than book value for the assets, as you said, getting a really, what the analysts are saying is a pretty good price. They're adding 197 facilities here. And I think one of the big things that needs to be spoken about here is the amount of people that are going to have to be integrated into this TFI system. TFI is going from 2,500 employees to something like 16,000 or 17,000 employees with this acquisition. So 8xing in size. But the potential here. So let's talk about what they're going to need to do to achieve that 90% OR that they say that the goal to achieve. I think it is in 3, maybe 5 years to get there. So they're going to need to walk a tightrope to simultaneously drive service levels up and also drive yield improvements, which is not going to be easy. But analysts do think that it's possible. So the deal appears to allow for plenty of room for runway for TFI to improve the profitability of the business. From the call, the M&A call that you were mentioning earlier, CEO Alan Bedard said, "We see compelling opportunities to improve yield, efficiency, and productivity, both in near and long term through separate management of the LTL and dedicated truckload businesses." So that's one important thing. They're going to be splitting these. I think of the UPS freight, I think it's 12 or 14% of total revenue is on the dedicated side. That's going to be taken away out of the LTL business and given to the dedicated business of TFI. And then there's one last kicker here. Actually, let's wait on the union talk just for a moment, but let's go back to that. The idea of
the pros.
UPS freight, yeah, pros, but the idea of UPS freight being a centerpiece for what TFI is trying to do with its cross-border operation. So they've got a pretty robust operation in Canada, and they're also beefing up Mexican operations. But this UPS freight with huge lines up and down Texas and massive connection from Mexico to Canada can act as a kind of a centerpiece of this network, can it?
Yeah, I mean, absolutely. So I want to step back for a minute. I'm not actually bearish at all in this transaction. I'm undecided, despite my bad metaphor there, but I think there's a ton of pros here. They didn't pay much for this asset. They can drive a lot of yield improvements. The margins, so TFI has made 90 acquisitions over the last 12 years, according to the Bank of America note we read. So they're clearly seasoned pros at integrating assets, and they're probably better at doing it than everyone else. And if you look at just like the synergies and the accretion to the earnings from this, a lot of analysts think that if they can keep 3 of the 4 billion revenue in revenue, and then increase the margin to 10%, this could add like more than 50% to run rate EPS. So and given the fact that they're basically paying below replacement costs for trucks and hubs, that starts to look pretty good if they can pull this off. And the last thing I would say is, the multiple, even after a run up in the stock of, I think it's because it's up again today, it's somewhere between like 30 and 50%. It's up over the past 2 days. So the market clearly likes this deal. And not only that, the multiple, at least on an EBITDA and a PE basis of the consolidated entity, which is now going to be almost half LTL, is still way below, even after this run, is still way below sort of the blue chip, non-unionized LTLs in ODFL and Saia and XPO. So a lot of, like, in other words, this could be a transformative deal, and if they're successful, I think the market would gain a lot of confidence and probably re-rate this to a much higher multiple.
Yeah, I definitely think you're right about the investor sentiment. I mean, you can see Tom Wadowitz said it about the jump in share price. It's definitely investors feeling that the TFI's proven track record can translate into success here. I think there's another point to make just about the scale of TFI now. They're going to be the 5th largest LTL player in the country. And the LTL market structure, the industry structure, has been proven to be highly favorable to participants with scale. This is something you and I were talking about. It's much more concentrated than the truckload market. I think the Bank of America note said the top 10 carriers control more than 75% of the market. So this is a good point to be able to get them to a sort of scale where they can compete with the ODFLs and the Saias of the country.
Absolutely. And, we kind of talked about this. I mean, I guess we're signing off. Is that
I guess we're signing off. We will see you guys next week. This has been episode 57. Catch all of our stuff live on FreightWaves TV. Go to Freightcast to get all of our content on demand. Thanks. See you next time.